You opened the news this morning and saw it again. The Fed is cutting. The headlines say borrowing is getting cheaper. So you pulled up your lender's rate sheet, or maybe you refreshed the mortgage tab you've been watching for a year and a half. And the number on the screen is 6.39%. I keep seeing the same scene play out. A homeowner in their 50s or 60s does the math the way they were taught. Fed cuts, mortgage falls, refi window opens, retirement plan gets a little easier, and the math is not working. If you are that homeowner, sitting on equity, watching the headline cuts, waiting for a number that has not moved, I want to tell you why. Because the answer is not that the market is broken. The answer is that you have been watching the wrong rate. The Fed has cut by 175 basis points since September 2024. That is one of the fastest easing cycles in modern history, taking the target range from 5.25 down to 3.75. And the 30-year fixed mortgage today sits at 6.39%. Bond prices and bond yields move in opposite directions. That part of the rule you were taught is still true, but the rule is being applied to the wrong rate. Here is the part almost no one explains clearly. The Federal Open Market Committee does not set interest rates the way you might picture it. They set a target range for the federal funds rate, which is an overnight rate between banks. That is the only rate the Fed actually steers. Your 30-year mortgage? That is set in an open market by buyers and sellers of bonds. Every minute the market is open. So is the 10-year Treasury yield. So is the bond fund inside your 401k. The Fed influences those long rates. It does not control them. That is the answer to the title. The Fed cut the rate it controls. Your mortgage is priced off the rate the Fed does not control. As of this week, the 10-year Treasury yield is sitting at 4.39%, and the 30-year mortgage tracks roughly 2 points above it. Until the 10-year falls, your rate sheet is not changing, and the 10-year is not falling because three structural forces are pinning it up. You might be thinking, fine, the Fed influences long rates somehow even if it does not set them. That is true. The Fed has two main levers on the long end, the size of its balance sheet and forward guidance about future policy. And the first lever right now is working in reverse. Think back to 2020. During the pandemic, the Fed announced it would buy up to $1.25 trillion of agency mortgage-backed securities and $300 billion of longer-term treasuries. That program had a name, quantitative easing, and a mechanism. Economists call it the portfolio balance channel. The Fed pulls long-duration bonds out of the market. The supply available to private investors shrinks. Those investors bid up the price of what is left, and yields fall. That is how mortgage rates got to 2.65% in 2021. It was not magic. It was the Fed soaking up duration. What is happening now is the exact reverse. Quantitative tightening, the Fed letting bonds roll off its balance sheet without replacing them, dumps that duration back into the private market. Same channel, opposite direction. The Fed's current monthly cap on agency mortgage-backed securities runoff is $35 billion, which means up to $35 billion of mortgage-backed paper is being handed back to private buyers every month, year after year. Picture it as a faucet. For 13 years, the Fed had the faucet pouring into the market. Now they have reversed it. The bath is draining. And every month, private buyers have to absorb supply they did not have to absorb before. Now the obvious objection. Some economists argue the portfolio balance channel is overstated, that fiscal deficits and global inflation expectations matter more for long yields than what the Fed does with its balance sheet. Research from the Federal Reserve Banks of San Francisco and St. Louis has found the channel is real and measurable, but the magnitude is debated. Here's the thing, even if you take the smaller estimate, the directional pressure points the same way. Less Fed buying means more supply for private investors to swallow. The debate is about how much, not whether. And on the supply side, the pressure is structural. The U.S. Treasury has to keep selling long bonds because the federal government's interest costs are exploding. The Congressional Budget Office projects that net interest payments will surpass $1 trillion in fiscal 2026. Picture that, $1 trillion a year just paying interest on debt that already exists. The historian Niall Ferguson has a rule for this, Ferguson's Law. That says when a great power spends more on debt service than on defense, decline tends to follow. We are not quite there. In fiscal 2023, interest payments were $659 billion, and defense was $820.3 billion. Defense was still bigger, but interest is rising faster, and the trajectory is what matters. Here's what makes this a structural wall, not a temporary squeeze. The Congressional Budget Office estimates that a 0.1 percentage point rise in interest rates adds $379 billion to deficits over a decade. Stretch that to a full 1% rise, and you get roughly $3.79 trillion added to the deficit over 10 years. which forces the Treasury to issue more bonds, which puts more supply on the long end, which pushes yields up, which forces the Treasury to issue even more. The May 2024 refunding announcement maintained 10-year and 30-year auction sizes at $42 billion and $25 billion respectively, and signaled no anticipated decreases for several quarters. They cannot pull back, they have bills to pay. So if you are 55, 60, sitting on equity in your home and serious money in a retirement account, this is where the conversation gets personal. Because the same forces holding your mortgage at 6.39 are doing something to your bond fund you probably have not looked at. Pull up your target date fund's prospectus. Find the line that says effective duration or average duration. The Vanguard Total Bond Market Index Fund, one of the most widely held bond funds in retirement accounts in America, had an average duration of 5.7 years as of February 2026, down from 6.5 years in late 2020, but still substantial. Here's what that number means in dollars. A bond's price changes by roughly 1% for each 1% change in interest rates per year of duration. So a 5.7-year duration fund loses approximately 5 to 7% of value if yields rise 1%. On a $100,000 bond sleeve, that is $5,000 to $7,000 gone before any coupon income offsets it. You might be thinking, bonds are still the safe part of my portfolio, right? Stocks are the risky part. That has been the model for 40 years. And it has worked on average over long periods. I want to give that view its due. Bonds have shorter drawdowns, smaller losses, and priority in bankruptcy, but on average over long periods is doing a lot of work in that sentence. In 2022, target date funds aimed at people who had already retired were down over 11%, not because of stocks, because of duration. The bond sleeve did the damage. And here is the edge case that should bother you. If your bond sleeve has long duration exposure, meaningful holdings of 20-year or 30-year treasuries, the math gets uglier fast. A 30-year treasury with roughly 20 years of duration loses about 20% of value on a 1% yield rise. 20%. On the part of your portfolio you thought was safe. So 3 things to find inside your prospectus before the next FOMC meeting. First, the average duration number, that is your sensitivity. Second, the breakdown between short duration and long duration holdings. Those behave very differently in a steepening curve. Third, the fund's benchmark, so you know which yield to watch. Most are tracking something close to the 10-year Treasury, which means the 10-year is your real signal, not the Fed funds rate. Now here is where it gets strange, and this is the part most retirement analysis is still missing. There is a third force pushing on the curve, and it has nothing to do with the Fed or the Treasury. Tether, Circle, and Paxos, the 3 biggest stablecoin issuers, collectively held $182.4 billion in U.S. Treasury securities as of July 2025. That ranks them as the 17th largest holder of treasuries in the world, bigger than most sovereign wealth funds. Now, the skeptic in me wanted to push back on this when I first looked at the numbers. Stablecoin treasury holdings are still a small share of a treasury market measured in tens of trillions. They are not driving the whole curve. That is a fair pushback, and I take it. But here is what it misses. Stablecoin issuers do not buy across the curve. They buy almost entirely at the short end. Treasury bills with weeks or months to maturity, because they need to redeem on demand. So they are an enormous, persistent source of demand at the front of the curve, which means short rates have a buyer, the long end does not. The result is a steeper curve. Long rates stay sticky high, while short rates have a private bid Treasury did not used to count on. Picture 3 rivers all running into the same lake. The Fed shrinking its balance sheet is one river. The Treasury issuing record long duration supply is the second. Stablecoin demand concentrated at the short end is the third. They flow from different sources. They all push the same direction on the long end of the curve, up. That is why your mortgage is 6.39 instead of 4.8. You might still be wondering, okay, but is this just Powell's Fed being cautious? Will the next chair fix this? Jerome Powell is the current chair. He was sworn in February 2018 and reappointed in 2022. The incoming nominee is Kevin Warsh, who served as a Fed governor between 2006 and 2011. And here's the part that should land for you. Warsh has, on the public record going back nearly 2 decades, expressed skepticism about the size of the Fed's balance sheet, criticism of large-scale Treasury and mortgage-backed security purchases, and a preference for a smaller, more disciplined central bank. Some analysts argue this is an oversimplification of his views, that his philosophy is more nuanced than just letting long rates float free. That is fair. But the directional read is consistent with what he has written for 15 years. A Fed leadership that prefers a smaller balance sheet means more quantitative tightening, not less. Which means more long-duration supply for the private market to absorb. Which means the structural pressure on your mortgage rate is not going away because of who comes in next. So the answer to the question in the title, why your mortgage will not drop even as the Fed cuts, is that the Fed cut the wrong rate. The mortgage tracks the 10-year Treasury, which is set by an open market, and that market is being pushed up by Fed balance sheet runoff, record Treasury supply, and a stablecoin buyer base concentrating at the short end. None of those forces care what the FOMC does to the overnight rate. What can you actually do this week? Open your retirement account online, find the bond fund inside your target date allocation, click into its prospectus and search for the word duration. That number, 5 years, 6 years, 7 years, is your real risk number, not the Fed funds rate on the news. Look, I write about this stuff and I still want to be careful. This is general education, not personalized advice. Before you change anything inside your retirement account or make a move on your mortgage, talk to a financial advisor who can see your full picture. They will catch wrinkles a video like this cannot. If this changed how you think about which rate matters for your retirement, the like button helps me know. And if you want to stay ahead of this, there is a date coming that matters more than most 401k savers realize. A transition at the top of the Fed that will change what is sitting inside the supposedly safe part of your account. The next video the screen walks through 3 numbers to check inside your retirement plan before that transition lands. I will see you there.